What is up, YouTube? I'm Adam O'Dell, Chief Investment Strategist at moneyandmarkets.com. Typically, I'm joined by my research analyst, Matt Clark, but we gave him the day off, so today it is only me. But we do have a great question from one of our subscribers. I just recently, this year, launched a new trading service called Wednesday Windfalls. It's called Wednesday Windfalls because we close our trades every single week on Wednesday afternoon. So each week, I get you into 3 new trades on Monday afternoon. We get out of those 3 trades on Wednesday afternoon, and it's a lot of fun. We actually beta tested this service for well over 6 months. It was like 32 weeks and 96 individual trades overall. So we got a large sample size and had some amazing results during the beta test. So I'm excited to share that with more folks throughout the next year. But nonetheless, this question came from a new subscriber of Wednesday Windfalls. I give a weekly video presentation every week recapping our trade and teaching some fundamentals on the strategy. And this question came in. Basically, the backdrop of this question is I'd given an example and done some analysis on probabilities based on a fair coin flip. Okay, so heads, you win, tails, you lose. And I was trying to do an illustration of what's called the law of large numbers. Basically, the law of large numbers says that if you flip a coin 100 or 1,000 times, you're going to get very close to that 50-50 probability, 50% heads, 50% tails. But that's only when you have a large enough sample size. If you have a small sample size, like maybe 2 coin flips or 5 coin flips, then the odds of getting 4 or 5 tails in a row are much greater over a smaller sample size. So that's the backdrop behind this question. And it caused a little bit of confusion, but it's a great teaching moment because the way I like to trade is a way that's a little bit counterintuitive to some folks. And I'll explain that in just a moment. But the question that we got in our inbox, one of the questions this week was, I watched your recent video and it all makes sense what you explained. But what concerns me is the idea that you are coin tossing for a roughly 50-50% win rate. And that's a little bothersome. I get not having an 80 or 90% win rate, but what my impression was is that your strategy involved technical analysis of these stocks such that the odds of having winners was better than a coin toss. So this is a common feeling among investors. And that feeling is that if I win more often than I lose, then overall I'm going to make money. Whereas if I lose more often than I win, I'm going to lose money. And the emphasis is on the word more often or less often. And that is about the probability of success, or what we call the win rate. Okay. So if you make 10 trades and you win 5 of those trades and you lose 5 of those trades, then your win rate is 50%. Likewise, if you take 10 trades and you win 9 of those trades, then your win rate is 90%. Okay. So a lot of people think that your win rate is the only variable that drives your success over time, because it does feel intuitive that if you're winning more often, if you're winning more of your trades than you're losing, then you're going to do better. And it's a completely intuitive conclusion. But it misses the other key variable to your success over time trading any strategy. There are 2 variables. One of them is your win rate, how often you win on your trades versus how often you lose. The other important variable that this person that wrote in was kind of missing out on is the size of your winners relative to the size of your losers. Okay, so let me explain what trading expectancy is. So basically, expectancy is the combination of your win rate and the relative size of your winners and losers. So the expectancy, the answer tells you the dollar amount that you can expect to either make or lose on every single trade you make, of course, on average. And that the equation for expectancy is the probability of hitting on a winning trade times the size of your average winning trade. And from that total, you subtract the probability of encountering a losing trade times the size of your average losing trade. So again, you can see here that the probability of having a winning trade, your win rate is important, but also the relative size of your average win versus your average loss. So taking those 2 variables together, will tell you whether you're more likely to make money on every single trade, whether you have a positive expectancy or a positive edge is what a lot of people would call expectancy, or whether your strategy has a negative expectancy. And basically every $10 you put into the strategy, you're going to lose some portion of that every single trade. You don't want to trade a strategy that has negative expectancy. Now, there are two types of strategies, basically two sides of the coin, not to overuse the coin term, but basically there are positive skew strategies. And those are strategies that the win rate is maybe less than 50%. So you're not really winning more often than not. In fact, you're losing more of your trades. But the size of your winners are so much larger than the size of your losers that you end up coming out ahead in the end. And you will absolutely make profits with a positively skewed strategy. The converse to that, the other side, is a negatively skewed strategy. And that is characterized by the opposite combination. So basically you're winning more often than you're not, but the size of your winners are relatively small relative to the size of your losers. If you think about investing in the stock market, like a long only buy and hold investor, that's a negatively skewed strategy. You may have heard the term that stock prices take the escalator on the way up and the elevator on the way down. And what that basically means is that typically, over a string of days or weeks or months, the stock market will grind higher. And then every once in a while, something bad will happen or some news will come out and stocks will fall a large amount in a short amount of time. So that's an example of where you're winning more often than you're not, but the size of your winners are relatively small relative to the size of your losers. I actually like to trade positively skewed strategies. So where you may not be winning on most of your trades, but your winners are much larger than the size of your losers. And I'm also an options trader. So when you are buying options, whether you're buying call options, which is a bullish bet on a stock or ETF, or whether you're buying put options, which is a bearish bet, either way, when you're buying an option, you pay a fixed price for that option. And it's impossible to lose more than that amount. So let's say you invest $100 to buy a call option on stock ABC. You can't lose more than $100. But your upside potential, you can make 100, you can make 200, you can make 500, you can make 1,000. So the average and relative size of your winners is much, much larger than the size of your losers. And as I'll show you, that takes the pressure off of you to have a high win rate. You can lose more than 50% of your trades and still make money over time because the size of your winners is much larger. So here's an actionable example. I told you we made 96 trades during the beta testing of my new service, Wednesday Windfalls. Of those 96 trades, we only won 47.7% of them. We lost 52.6% of them, okay? So our win rate was less than 50%, okay? Now, again, that intuitively may sound bad. How can you win money if you're, losing more often than you're not? But the key to our success during this beta test was the size of our winners relative to the size of our losers, okay? So based on investing $500 per position on every single position, the average size of our winning trades was $666.88. Relative to the size of our average losing trades, which was only $247.21, okay? So our win rate was slightly less than 50%, but the size of our winners was nearly 3 times larger than the size of our losers, okay? So what that resulted in was an expectancy of $186.07. So what that means is that every single trade we made, investing $500 per trade, we could expect a profit of $186.07 on every single trade, which equates to about 37% gain. Okay, so we made those gains in 2 days. And remember, this service we're getting in on Monday, out on Wednesday. And so we averaged a gain of 37% every single trade over those 96 trades. And again, that was only possible because the size of our winners was much larger than the size of our losers. So we could take a 50-50 coin toss proposition and still make money over time. Now, one table that I always keep close at hand because it reminds me of why it's important to have larger winners than losers is this table. And it basically shows that for a given win to loss ratio, meaning the size of your winners relative to the size of your losers, As that number increases, as the size of your winners gets larger and larger and larger relative to your losers, the win rate that you need to just break even on that strategy goes down precipitously, okay? So let's look at the numbers in yellow first. First of all, 1-to-1. If on your average losing trade, you lose $100, and on your average winning trade, you win $100, so it's a 1-to-1 ratio, then you have to be right at least 50% of the time to break even. Otherwise, you're going to lose money. If you go further into that yellow block where your win ratio is 0.5-to-1 or 0.25-to-1, which means that your losing trades are larger than your winning trades. Okay, so you're taking small wins. Maybe you make $100 on your winners, but you lose $200 or $300 on your losers. Then your win rate has to be much better. Your win rate has to be either 67% or higher, or in the case of 0.25-to-1, your win rate has to be over 80%. And that's really difficult. There aren't too many strategies out there where you can achieve an 80% win rate or higher. Most of them involve naked selling of options, which is a whole nother subject for another day. But that is definitely a strategy where you're taking home small wins, usually day in and day out. And then occasionally you get hit with a very large loser, and that kind of tends to wipe a lot of people out. But let's look at the green box now, where the size of your winners is 2-to-1. So for every $1 that you lose, you typically win $2, or 3-to-1, or 4-to-1, or 5-to-1, or even 6-to-1. If you can find a strategy where you're taking home $600 of profit versus a risk or a typical loss of $100, then that is an amazing strategy, because you only have to be right 14% of the time, okay? So look at these win rates. If you just have a 2-to-1 win-to-loss ratio, you only have to be right 1 out of 3 times, okay? So you can have 2 losing trades, 1 winning trade, and the size of that 1 winning trade is going to be enough to at least break even for you. So 3-to-1 is even better. 4-to-1 is amazing. 5-to-1, 6-to-1 is absolutely amazing. So again, just to kind of tie it back to the 96 trades that we did during beta testing of my Wednesday Windfall service, the average size of our winners was 2.7 times larger than the average size of our losing trades. Okay, so that is a very favorable win-to-loss ratio. And because the size of our winners was 2.7 times larger than the size of our losers, we only need a win rate of 27%. Okay, so we need to do a little bit better than 1 in 4 winning trades to break even on the strategy. Now, I mentioned earlier that our win rate was 47%. So when you take a win-to-loss ratio of 2.7-to-1 and a win rate of 47%, that's when you can average a 37% gain on every single trade. So again, that's just kind of, I wanted to kind of clear up. I don't like to get involved in too many, technical subjects or math-based subjects here on YouTube. But nonetheless, I think that the take-home message is this. If you can find a strategy where your winners are typically going to be much larger in size than your losers, then that can be a great strategy, because it takes the pressure off of winning 50 or 60 or 70% of your trades. In fact, there are many very successful strategies. Trend following is probably the largest example and the most ubiquitous example, where trend followers typically are not winning more than 50% of your trades. I follow a lot of trend following funds where their win rate is in the 30% range. And nonetheless, because the size of their winners is so much larger than the size of their losers, they do make money over time. So that's the take home for today. We'll be back next week with Matt Clark, my research analyst, and we'll definitely include some links. And if you have any questions, make sure to leave us a comment, leave us a question in the comments below, and I will see you next week. Thanks so much.